There's something weird going on in the real estate space. So Barry Sternlicht of the Starwood Real Estate Income Trust just issued something that's not so juicy. Now I'm going to explain this, but let me just give you a quick overview. When people want to get out of some of these real estate funds or whatever, the fund has to sell underlying assets to give people liquidity. In this case, if there's no liquidity, they have to dump real estate. And what they're trying to say is, we're having to dump so much real estate because people are wanting out. We think this is a really bad time to dump real estate. Now, this is creating some really interesting implications for the real estate market. And I want to read this to you because they give a forecast. Then, after their forecast, we're also going to go ahead and take a peek at what's going on with inventory in different parts of the country. It's a really big deal. But first, I'd like to celebrate with you. I think congratulations are finally in order for our Webull trading account. The Webull trading account just today hit a $1 million realized P&L. Let's go. This is just the trading account where I do short and swing trades, so basically day trades or swing trades. Today, there was basically $137,000 a day. I was trading with about $60,000 at a time. So that's pretty good. That's about a double on that 60K. And so I would just go in and out on, actually, I think all of these were short positions. There was a moment I was long on AMD, but most of these were all short positions. And they just printed dollars today. It just sort of waited for local tops or NVIDIA to top out and boom, entered shorts. It was great. If you want all those buy-sell alerts, make sure you're part of the Stocks and Psychology of Money group. We have a coupon expiring next Friday. You get all the course lectures in it, all the buy-sell alerts, which are designed to give you sort of perspective on what kind of trends might be happening on the day. Obviously, I can't guarantee your results. I can't guarantee that I'm going to be able to continue to trade like this. Knock on wood, man, because like I'm nervous. I'm like, this is crazy. This is crazy. I really only actively started trading probably more so in March. I had some trades at the beginning of the year, but very few. Lately, it's been like daily. And I'm just going to knock on wood. That's all I'm going to say. Again, zero guarantees, but do check it out at meetkevin.com if you want some of those alerts and kind of be part of what's on my mind when I send my strategies out. So with that, let's jump on over now to what's going on with Barry Sternlicht. So Starwood Real Estate Trust, they just filed this moments ago, and take a look at this under the liquidity section. They say they're committed to providing liquidity to our stakeholders or stockholders. And to provide liquidity, we've taken a balanced approach, including selling real estate, selling stocks or I guess other assets, securities, utilizing cash, and using our credit line. Now that creates some problems because if people are withdrawing their money out of your real estate fund and you're taking on debt to finance those withdrawals, you're going to run into some problems where you might have to start selling real estate more rapidly at more distressed prices, right? If somebody's forcing you to sell, you have to potentially be willing to take a lower price. So far, this institutional loan has sold $2.8 billion of real estate, including $1.8 billion of multifamily, industrial, and real estate loans. That's a lot. Now, they've done well because they bought a lot of these properties during sort of the COVID bubble, which everything since then has just done well with the exception of Tesla stock. Okay, all right, sorry, we don't need to get this wrong video for this. Let's just focus on real estate. But take a look at this. While redemption requests are down from their peak in January of 2023, they've remained above our share repurchase plan's monthly and quarterly limits for the past year and a half. To meet the continued level of redemptions, real estate property sales became increasingly necessary to execute our ongoing liquidity strategy. That's not great. It basically means they've run out of where they feel comfortable just using their free cash or their credit line to basically finance or fund withdrawals. And now they're like, now we got to sell properties, but there's a problem. See, earlier this year, there were basically these calls for 6 interest rate cuts in 2024, and most property owners who could wait to sell waited. This was a worldwide phenomenon. It's safe to say the majority of sellers in the fourth quarter of 2023 through early 2024 were forced or distressed sellers. Bingo! What have I been saying, by the way, for like a year and a half now? With house hack, I'm like, we're going to buy at the end of 2023 because we think that's going to be where the best deals are in a sort of a local bottom, Q3, Q4. That's exactly what we've been doing. But I stopped buying for house hack kind of at the end of Q1. And we wrapped up another purchase last month. But anyway, one of the reasons for that, and we're keeping another $7-8 million on the side right now, is because I think there might be a little bit of near-term distress. I'm not convinced we're going to get to lower prices than what we had last year. We're already up on a lot of our really good purchases, which is amazing. I'm excited about that, knock on wood. But why do I think prices might come under some pressure here? Well, a lot of it has to do with inventory rising. Inventory is exploding, especially in the COVID bubble markets, and I'm not exactly sure where Barry Sternlicht and his fund spent a lot of their time buying during COVID, but if they're anything like anybody else, they bought in Austin and Florida and some of these markets that were unfortunately a little overbuilt, and those aren't bad markets. Like, I love the markets, but they were just overbuilt, and now you're dealing with excess inventory and not enough buyers. And so listen to his words, and then we could speculate some more. Okay, here we go. Okay, so as a result of all these expectations and stuff, we are choosing to slow our property sales for sunnier skies. Okay, so what you're saying is things suck right now. So I'm gonna write that down here so we have clarity. AKA, right now, things suck. Okay, well, I like being a contrarian, so if they're complaining about things sucking, I wanna see potentially why things are sucking, because maybe I wanna buy. That's kind of how I made money today on shorting basically NVIDIA adjacent plays or even ELF, is once I started seeing them top out, I'm like, this is coming down. And I basically just went in and out, in and out, in and out, trying to pick up $10, $20, $30,000 at a time on trades, and it worked really well. I like having the same mindset in real estate where it's like, okay, well, somebody else is panicking. Can I see if I find, a bottom, so to speak, and then I go shopping? This might be something that you're thinking of as well. And so I'll show you what you want to pay attention to for which markets are potentially feeling the most pain. Their current outlook, they say, which includes the Fed's lower interest rate forecast, improving capital markets, declining lender spreads, and a decline in new construction, all point to what we believe will be a more advantageous environment for real estate in the future. So in other words, please don't force us to sell now. We might be making a bottom. And we don't want to sell at bottom, is basically what they're saying. Now, I'm not making up the word bottom. I want you to see it in their words. We cannot recommend being an aggressive seller of real estate assets today, given what we believe may be near bottom market with limited transaction volume. Okay, so they think we're close or creating a local real estate bottom. And as a result, what they're saying, this is a little complicated, but basically, NAV, think of it as sort of their portfolio, net asset value. They used to have a rule that you could sell up to 2%, or the company could sell up to 2% of the portfolio per month, 5% per quarter. They've cut that to 0.33 per month, or 1% per quarter, and they're lowering their asset management fee from 1.25% per year to 1% per year. I hate all these freaking fees, but whatever. I'm very anti-fee, but whatever. So anyway, this is very interesting because they're saying, hey, this market may not actually be functioning properly right now. See, that's very interesting because I've built this channel on the back of real estate is an inefficient market, and I'm going to take advantage of the real estate inefficiencies. And so, I mean, I'm not trying to like cheer when somebody else is struggling, but the fact that they're getting a lot of redemptions tells me we might be onto something because I think they bought in COVID bubbly markets, and I want to show you something to identify. Watch this. If I jump on over here on my good old Windows PC, there are a few things you're going to see. The first thing you're going to see is a new sponsor that we have for the channel. It's actually Coinbase, which is really exciting. They set us up for an institutional account. Super cool. And we're kind of excited to partner with them, mostly because we think as crypto gets more and more positively regulated, it'll be easier for people to potentially invest in, startups or whatever using crypto. I don't think we're exactly there yet, but we'll see maybe with this Ethereum ETF, hopeful approval. But anyway, Go to metkevin.com/Coinbase. You could get up to $200 for getting started with crypto or with Coinbase. Earn free crypto after making your first purchase. Obviously, this is a crypto brokerage, so keep that in mind. Some people look at Coinbase as potentially having a little bit too much risk because of the exposure to SEC lawsuits. Personally, and I've made videos on this before, I think Coinbase is likely to win those, but just do keep in mind there's obviously risk with any kind of company in the crypto space. But anyway, thanks so much Coinbase for sponsoring. Now, I do want to look at this specifically here. So look at this. So let's go through this together and pick some, let's call them COVID markets. So I'm going to look at active listings. And look at the active listings explosion over here. Year over year, we're up 21% in active listings in Phoenix. That's one of your COVID markets. What's another COVID market? How about Tampa, Florida? Year over year, we're up 14.8% in Tampa, Florida. This is actually all metro areas. Sorry. So the entire country is up 14.5%. Tampa is up 54%. Holy crap, that's huge. What's another COVID market? Oh, Austin, Texas. Austin, Texas, up 14%, so more in line with the country. What about Houston? Another kind of COVID market. Houston's up 22%. And see, when inventory goes up and buyers go down, you end up seeing a housing supply, like a month's supply of housing, plummet. And that's not very good. But there's a difference between where this is happening and where it's not happening. And I'll show you that here. First, understand this. Let's go back to the iPad for a moment. When you have real estate for sale, remember that let's say there are two buyers, 2 buys per month, and there are 10 houses on market. Okay? What is your month's supply of housing? How many months until you're out of homes? Well, if you're buying 2 a month, and there are 10 homes on the market, well, you have 5 months of supply. I'll call it MS, right? Now, if I change this and I say, hey, we're gonna go ahead and say only one person is buying now, and there are now 20 homes on the market. Well, then we will literally have gone from 5 months of supply to 20 months of supply. In other words, buyers have a lot more choice, and that one seller who's like, I need to sell because my fund is forcing redemptions, well, you're gonna have to take a big L, potentially. I mean, maybe it depends on when you bought, obviously, but you're gonna have to sell for less. You're gonna have to get aggressive. And remember what Barry said. Let's go on the prior page here. Barry said right here, where was it? We cannot recommend being an aggressive seller of real estate today, given what we believe to be a near bottom in the real estate market. Okay, that's interesting. Well, wait a minute. Let's go back to this inventory situation for a moment. So your COVID markets like Florida and Texas and Phoenix, they're getting hit with a lot more inventory, which, you know, I've flown around the country now for the last year and a half exploring and studying the real estate market so that I can do my best to put house hack on the best foundations. And this is consistent with what we're seeing. Like what I'm seeing in the data now is why I've already been seeing on the ground in the real estate market for over a year. Like I got a lead of a year on all this data because I take this plane that I pay for so I can see it on the ground and talk to agents, because you have to think about it. If a buyer, you know, is going to take 90 to 120 days to actually find a place, find a realtor and close a deal, you start getting leading indicators way before other people when you actually talk to people on the ground, your boots on the ground, right? Now, what's the other thing that I'm saying though? Well, the other thing that I'm saying is underbuilt areas, specifically your blue states, right? So red states, like Texas, right? These are overbuilt, so you're seeing inventory up. Arizona, inventory up. What about the blue states, those underbuilt markets like California that everybody was fleeing from during COVID? Well, let's just type in San Francisco, for example. Wow, inventory is up just 6% year over year. Or let's do another one. Seattle, only up 12%. So obviously you're going to get some variability here in these numbers, but you're likely going to see less inventory coming on the market in these underbuilt areas because there just isn't as much new construction to flood the market with, and you're getting a little bit less distress out there. Now let's see if that's true of median sales prices. So median sales prices in Seattle are actually up 7% year over year. What about San Francisco? Year over year in San Francisco, you're actually up 6%. Okay, so up 6 to 7% in San Francisco, Seattle. What about Austin, where that inventory is up quite a bit? Interesting. You're only up 2%. A strong underperformance. What about Houston, Texas? Houston, Texas, only up 3%. What about Tampa, Florida? Tampa, Florida, you're up about 5%, but also lagging those more underbuilt areas. Let's try another one. Let's go with Jacksonville. Jacksonville, Florida. Jacksonville, Florida, up about 4%. Let's do San Diego for giggles. San Diego, in terms of pricing, is up 7%. So now you're seeing a few things. You're seeing pricing that is stronger in the blue states with less inventory. That makes sense. You also had a substantially larger hole in inventory in some of the markets. And in the more overbuilt areas, you're seeing inventory come up and it's starting to weigh on pricing. Plus, now you're starting to potentially create this sort of fund panic, where in my opinion, this sort of signal could create more fear. So I'm reiterating my thesis that I think this third and fourth quarter could be a really good time to buy real estate again. I think a lot of people were speculating that, because rates would come down at some point this year, real estate prices will definitely come up. I don't necessarily think that's true. I mean, first of all, we haven't seen rates come down yet. But even when rates do come down, I think we're just going to unlock more sellers. So I'm not very enthusiastic about this moon of a rocket ship, especially in the red states. For right now, I'm more enthusiastic about stabilizing real estate. That is, you'll have some tumult, you'll have inventory numbers change. I'm personally focusing my buys on those underbuilt liberal blue states. That's what we're doing with House Hack. We're putting our money where our mouth is. And then once we get a bottom in like the Texas markets and some of these other markets, Arizona, we're going to expand to those and make our way over to the East Coast. So these are just some of the trends that I'm seeing in the real estate market right now. And hopefully this is useful to you. If it is, keep in mind that yes, not only do I have that Stocks and Psych course where I trade and send sort of ideas and alerts and perspectives, it's all about education. I do the same thing in real estate. We have a 0 to Millionaire real estate investing course where I teach you how to actually negotiate a good deal, how to get a wedge deal in single family or multifamily real estate, and what questions to ask so you could do your own boots on the ground research and see it before it shows up in the data. I just give all that education away. Well, obviously you pay for it in the courses on building your wealth. You only pay once though. There's no monthly fee. You pay one time, you get lifetime access forever. So as things change or you have questions and you ask me in the course member live stream, I can answer them for you. Now remember, obviously nothing in this video or those programs is personalized financial advice. It's just designed to be education so you could see, okay, here's some information I could use in my own investing, and ultimately what you do with it is up to you. Obviously, I hope everybody wins. Thanks so much for watching. Wish you all the best. This is interesting news, and we'll see you soon.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than House Hack, nor am I presently acting as a market maker. Make sure if you're considering investing in House Hack to always read the PPM at househack.com.